Hi, welcome to the viewers who just joined our webinar for today. We're going to give a few more minutes to wait for other viewers to join us. Good afternoon, everybody. My name is Angelique Palomar. I'm the Communications Associate at the Institute for College Access and Success. Thank you all for joining TICAS and our guest experts from Center for American Progress and the Education Trust for our fourth California Student Aid Workshop webinar on federal grants, loans, and repayment options. Today's panelists are Colleen Campbell. She is the Director of Post-Secondary Education at Center for American Progress. Reed Setzer, the Director of Government Affairs at the Education Trust, and Michelle Streeter, the External Affairs and Policy Analyst at TICAS. Reed will cover Pell Grants, followed by Michelle, who's focusing on federal student loans. And then Michelle will turn it over to Colleen, who will cover repayment options. We'll wrap up today's webinar with a Q&A, which will be facilitated by TICAS's very own Associate California Program Director, Laura Zabo-Kiewicz. So if you have any questions at any point during this webinar, please use the Q&A button and not the chat box, and we'll get to it after our panelists cover their topics. Before handing it over to Reed, wanted to let our viewers know that we are recording this session, which will be made available on ticas.org, and it will also be sent around with a brief feedback form. So without further ado, Reed, go ahead and take the stage. Reed?
Hello? Can you hear me now?
Yes, we can.
Perfect. Sorry, I was on mute. So you can see there, there's an explanation of Ed Trust and who we are. I think a shorter version would just be that we are a national nonprofit that focuses on closing racial and socioeconomic equity gaps at both the P-12 and higher education level. This discussion will obviously be focused on Pell. We have offices in the Bay Area in California and do work on state level policy there, as well as Michigan and New York, and also an on-the-ground presence in about 8 to 10 other states. I am based in DC, and we have a federal practice here as well. Next slide. Great. So talk about the Pell Grant. I'm sure this is something that most folks on this webinar are familiar with, but we definitely want to give a little background context. Talk about how students get it, how it's funded, and sort of what's going on right now at the federal level. So as an overview, you can see here, there's some data points. I think from a philosophical perspective, Pell is sort of the bedrock commitment by the federal government to students around this country, specifically low-income students, to try and provide money for them to attend school, to allow traditionally underrepresented populations in higher ed, to have access into our higher education system. It is a substantial amount of the money that goes out. However, it's dwarfed in size by the loan portfolio, which my other panelists will touch on. But it is important to know it is the single largest grant program. You see 28 million. The high watermark, I think, over the past decade was actually during the recession. It got up to, I believe, 34 billion. Roughly 4 in 10 undergraduates receive Pell. So you're going to have a pretty large population within the overall student population that is familiar with the grant, that relies upon the grant, which is important. It's important in showing impact. It's also important showing that there's a constituency that is impacted and any changes that are made to the program, constituency that sometimes you can mobilize to take action to improve the program or at the very least prevent any sort of damaging policy decisions that are made. As you can see, it's actually interesting too. You have Pell recipients, a lot of folks, I think, regardless of your experience in the space, assume that the majority of students are first-time, full-time. For Pell recipients, actually almost half are over the age of 24. So you do have a lot of older learners coming back and using Pell. It is important to close racial socioeconomic equity gaps, both through the income measure, which Pell was awarded, but also you can see here that roughly 6 in 10 Black students and roughly half of all Latinx students receive Pell. And the vast majority of students actually are, I think, would be considered low income. They're certainly well below the national average in income. And the maximum Pell Grant Award 2019 was a little over $6,000. The average grant in 2016, which is the most recent year we have available, is around $3,700. So that's a broad overview of the program as is. Next slide, please. So how do students get Pell? So a couple different bullet points here. Some are more technical, some are pretty broad. So in the broadest sense, you have to be enrolled in an eligible higher education program. That's one that's going to be determined eligible by what's called the triad. Without getting into a lot of highly specific things, you can basically understand the triad as the Department of Education. They're making decisions on what schools are eligible. Your state, the state body, maybe it's a state board of education or a state department of education, and accreditors, which are sort of a peer network of folks who are essentially empowered by the federal government and state governments to value school quality. There's some issues with exactly how that's done, and I think people are very interested in improving that system. But essentially, when you're talking about what is a quote-unquote eligible higher education program, it's going to be one that's approved by those three entities. Secondarily, and probably more familiar, is the FAFSA. In order to get federal financial aid, you have to fill out a FAFSA. Right now, that's 108 questions. There's a movement to improve and simplify that, and hopefully that will happen sooner rather than later. But that is a prerequisite to get financial aid, period, whether that's Pell or any other type of aid. Additionally, you have to be from a household that qualifies financially. So you saw before that the vast majority of students are from families with income below 40,000. If you're actually from a household, single-person household, and you come from a household that's $25,000 or less, you'll be considered what's auto zero, which again, without getting into all the technical language around that, essentially you'll be automatically awarded the maximum award, which, as I noted, is roughly $6,200 right now. As you go up the income ladder, and it's also dependent on household size, the award will diminish, so it'll get smaller and smaller. Roughly around $60,000 in income, you'll actually phase out of the award. It wouldn't get anything. Folks who are north of $50,000, between $50,000 and $60,000, you're talking about hundreds of dollars, not thousands, that folks are getting through Pell. Also, once you are in Pell or enrolled in school receiving Pell, you have to maintain satisfactory academic progress, which is a federal standard, which is a 2.0 GPA. Students must be citizens, so this is a current topic of debate, which we can touch on a little bit later. But right now, if you are an undocumented immigrant or a non-citizen, you cannot get Pell. You have to register for selective service and not be in current student loan default. So if you went previously to school and did not use up your Pell eligibility and did not get an undergraduate degree, you have to actually be current on your loans to go back and finish, which you can imagine it is problematic for some folks. Another thing worth mentioning is that in 1994, a ban on Pell going to students who are incarcerated was put in place. It dramatically lowered the amount of programs that were available in carceral facilities, and that's something right now that Trust and several other groups are working on trying to get removed. Next slide, please. So this is a little bit complicated, but I think worth it to dig into a little bit. How is Pell funded? Because, I think it is important to note, you can talk about sort of the eligibility restrictions. So I just mentioned the ban for incarcerated students or folks who are undocumented not being able to get Pell. And that's one side of the kind of the policy space. We're talking about changing the program and eligibility. The other side is annual, and that's the appropriation side. So how do you make sure that money continues to flow through the program? And quite frankly, because there has not been a ton of authorizing changes, there have been some in higher ed over the past couple of years. The appropriation cycle is actually really important to pay attention to as well. So how does all this work? It's more complicated than your, I guess, typical federal funding scheme. What you're going to need to understand is there's a discretionary side of the budget, and what that means is that's annual. So that's the annual cycle, year-to-year appropriations to fund any program, not just Pell, but in this context, Pell. And then there's a mandatory side budget. So when you hear mandatory, you think Social Security, you think Medicare, things that kind of run on autopilot, that have been authorized in law that don't need separate bills every year to keep them going. So Pell has a little bit of column A and a little bit of column B. The majority of the program is funded year to year. So you can see, upwards of 80%. That fluctuates depending on the size of the award, but roughly you're always going to have a majority funded through the discretionary funding stream. So in terms of educating people on what's going on, you're going to want to see any headlines about appropriations committees, headlines about the budget writ large, to make sure that there may be times for folks on the ground to intervene and say, hey, we see there's been a rumored cut to Pell. We don't want that to happen. And that's going to happen every year. The calendar is kind of screwed up, given Congress doesn't really operate on the actual calendar they're supposed to anymore. But it is important to be mindful of that. Just to explain mandatory funding a little bit as well. So the discretionary funding, every year right now is roughly around $5,000, and that just gets funded every year. That has to be funded. Running on autopilot in the background, there's a $1,000 add-on. So when I say to you, Pell right now is around $6,200 a year, 1,000 of that 6,200 is actually just operating on autopilot and gets added on to whatever Congress appropriates in a given year. So it's sort of this little extra, I hesitate to call it a bonus, but it is something that is tacked on to what the business of Congress is annually. It used to be indexed to inflation. This expired in 2018, so right now this is frozen. We want that to be restored as well. So I think, it's a little bit confusing, and unfortunately I always stick around for questions, but I did want to note that there is that dichotomy and that difference. Next slide, please. So current areas of change. I mentioned a couple of these already. These are areas that are under debate currently. One is just increasing the maximum award, right? So you may be familiar with, this statistic, but people are constantly citing how the purchasing power of the grant has declined. So right now it covers less than 30% of the average cost of attendance in a public four-year institution. Back in the 1970s, it covered upwards of 75%, and that has eroded over time as college has gotten more expensive. Pell is covered less and less. So in order to restore that purchasing power and take more of the burden off students and families, we want to see that award increased. I mentioned re-indexing the mandatory side to inflation, so that would provide at least a small bump every year. There's another push to make it fully mandatory funded. So if you look at this program as a sort of commitment that schools should be making, and the country should be making to low-income students, having it be subject to annual appropriations is very haphazard. It risks, all kinds of negative effects, both from a policy perspective and sort of an administration perspective. So could make this run on autopilot and make it fully secured. I mentioned undocumented folks, certainly expanding Pell out to DACA, DAPA, and TPS recipients. Noted earlier for something like DAPA, actually a lot of the folks who get Pell are older than you might think at first impression. I mentioned the incarcerated students ban. And another area of possible change, which is a little bit more concerning, would be allowing Pell to be used for short-term certificate programs. Many of these programs have not the best outcomes, and right now the debate to expand Pell to cover some of these short-term programs, would not necessarily make that money dependent on outcomes. So you could have it funding some poor programs. Studies show that the folks that traditionally do the best in short-term certificate programs are folks that already have a bachelor's degree, and that's not exactly where this debate is focused on. It's focused on trying to get folks skills who might be less than that. So that is something to note, that's floating out there. There is interest on both sides of the aisle for that as well. Next slide, please. So before kind of circling up with what's going on right now in Congress, thought it would be, and it's sort of what's happened in the past, thought it would be useful just to flag some other things that are out there. This is very Pell focused, but real quick, there are other federal financial aid programs worth noting. Another one probably familiar with is Federal Work Study, reaches over 700,000 students annually. It's funded over $1 billion. It's actually received funding increase the past 2 years. It's given out through the schools, depending on a few factors. You know, the schools have some leeway on who they give money to. It's funded, the schools receive money originally through a separate funding formula that is different than Pell. It's a separate process. So essentially, you know, that's a program that's worth noting that does help quite a few students. It's also mentioning FSEOG. So this is another campus-based aid program. So unlike Pell, which goes to the student and the student takes it somewhere where they want to attend college, Federal Work Study and FSEOG actually go to the school first, and the school has that pot of money, and then once they have their group of students, they then give that money out. FSEOG is dependent on financial need, first and foremost. It is sort of, you can think about it as a supplement to Pell for the lowest income students in the country, and the maximum award in a given year is $4,000. Also worth mentioning quickly, Teach Grants. You know, there's a scholarship program where students can receive $4,000 annually, preparing to teach in high need schools. There's been some administrability challenges there, but another way for folks, if they're curious about, you know, what's out there for me when I'm trying to navigate the system, there are some you know, grants specifically for teachers who are teaching in high need schools. It's also worth noting that TRIO and Gear Up exist. They're essentially designed to help low income students get to college and then through college. They do different things. I don't want to get into all the details there because this is Pell focused, but worth noting that the type of students that get Pell are often the type of students that will benefit from TRIO programs that are designed to make students basically acclimate easier on campus and limit the risk of dropping out or stopping out. Next slide, please. So another thing worth flagging is many times we talk about these things, we talk about the financial aid system, people ask, like, how did we get here? And that's a very long answer, but a short timeline is here for people's identification, right? So the whole system, you know, we're talking about, you know, 1965 to 2019, you know, so it's been around for roughly 50 years or so. You know, Pell Grants were created in 1972, so they've been around for quite some time. That's how we have that information about how the purchasing power has declined over time. The FAFSA, which I'm sure many folks on this webinar have dealt with, created in 1992. You know, the Teach Grant program I mentioned, that mandatory funding stream is more recent. So a lot of these changes, you'll hear people talk about them, and you may not realize that actually there has been a lot of activity in the past decade, specifically, you know, in the years immediately before the Obama administration came in, and then throughout the Obama administration, there were some substantive changes made. You know, there was a temporary boost to Pell as part of the stimulus package, created year-round Pell, which allows folks who are Pell recipients to use it in the summer, so it gets them through school faster. Congress ended that program, but then brought it back in 2017, and that was a big win, I think, for a lot of folks on this webinar, certainly the panelists, and continue to try and expand and improve the program in the same manner that we did back 2 years ago. Next slide. So where are we at right now? You know, all this is fine and well. Pell is extremely important. I think folks agree on that writ large, and that's bipartisan. But, you know, what are possible changes that have been proposed? So in the past, you know, I guess it's roughly sneaking up on 2 years now, House Republicans initially sort of introduced their comprehensive ACA reauthorization bill. It's called the PROSPER Act. You know, Pell is a large piece, but still one piece of the larger Higher Education Act. And so any sort of comprehensive bill is going to have to impact Pell one way or another. You know, this bill increased Pell to short-term programs. It did not increase the max award. It did pass the committee on party lines, but it actually had opposition within the House GOP caucus. So they did mark it up. It was 12 hours long. There were, just to not skip past that, but a markup is essentially a public amendment process in committee where you'll have each party offer amendments. They'll go back and forth. They'll vote on each one. So after a full day of that, the Republican majority at the time voted that bill out. However, it did not get a vote on the House floor. There were opposition, as I mentioned, centered around a couple of different things. One was changes to the thorough study program. There were not, that I'm aware of, changes to Pell that certain members of the GOP caucus objected to. But this was not necessarily regarded as a bill that was going to invest or improve Pell. I think fast forward to this year, there's been quite a bit of action. 2019, September, at the end of the month, so not very long ago, Senate Republicans introduced a smaller HEA package called the Student Aid Improvement Act of 2019. This specifically was introduced by Senator Lamar Alexander. So if you hear, the Alexander bill or the Alexander HEA bill, this is almost certainly what folks are referring to. This would also expand Pell to short-term programs. It did raise the max award by only $20, which is not very much, obviously. It would not be tremendously impactful. So certainly, we want to continue to push, greater investment than that. When we're talking about raising the max award, we're talking about, doubling it over a period of time. So that is sort of what's been going on the Senate side. On the House side, even more recently, as a few weeks ago, House Democrats introduced their comprehensive HEA reauthorization bill called the College Affordability Act. The bill is about 1,100 pages. It builds on a bill that was introduced last summer called the Empire Act. It's a lot of similar language there. This does include sort of a federal-state partnership to create community college, tuition-free community college. As far as Pell is concerned, it increased it by $500 and reinstated the inflation index that I mentioned earlier. It also does expand Pell to short-term programs, but does lift the ban on Pell going to students who are incarcerated, as well as extend federal financial aid to undocumented folks. So there's a lot of things in there that would expand and invest in the Pell Grant program. Worth noting, before I turn it over to Michelle, that there is actually going to be a public markup tomorrow of the House Democratic bill. It will run from 10:15 in the morning, probably until midnight. If folks, have time, it'll be broadcast online. You can search, I think, House Ed and Labor on Google and watch that and sit through some of that. I wouldn't recommend all of it because it'll be quite a long day. But essentially, that bill is expected to move through committee tomorrow, and then there will be a floor vote at some point. No one's entirely sure when, but worth it to reach out to your congressperson at that time. When it does hit the floor, and certainly let them know what you think. It is very large, but there are significant improvements from a trust perspective in that bill. So with that, I will stop and turn it over to Michelle.
Great, thanks, Reed. Hi, can everyone hear me okay?
Yes, we can.
Cool, great. Hi, everyone. My name is Michelle Streeter. I work on college affordability and student debt policy here at TICAS. I'm based in our DC office and work on federal policy. TICAS, as I'm sure all of you know, is a national nonprofit based in both Oakland, California and DC. We are focused on making college more affordable and accessible for students from all backgrounds, and our work combines research, in-depth policy analysis, and advocacy. So I'll be going through an overview 101 of the basics about the front end of the Federal Direct Student Loan Program, also known as the Federal Loan Program, which is the source of more than 90% of the student loans that are made annually in this country. So when you hear about student loan policy and student debt, most of this debt is coming from this Federal Direct Student Loan Program. So to give you a sense of scale, as of June 2019, there were 18.5 million FAFSAs submitted for the 2018-19 academic year. And as of October 3rd, 2019, the outstanding federal student loan portfolio stood at almost $1.5 trillion, a number I'm sure many of you hear all the time. So nationally, 65% of college seniors who graduated from public and private nonprofit colleges in 2018 had some student loan debt. And these borrowers owed an average of $29,200. And in California specifically, 49% of those same graduates had student debt. and in California owed an average of $22,585. So undoubtedly, you'll have heard a lot about student debt in the national conversation, especially over the past several years. So I'm going to dig a little bit deeper into kind of the basics of what federal student loans actually are, how they're made, and what the terms and conditions of the loans are. So first of all federal education loans, those made to undergraduate students, graduate and professional students, and parents are made by the U.S. Department of Education. So the U.S. government is the lender, and all payments are owed and made to the Department of Education. So within the department, the Office of Federal Student Aid is the office managing the federal loan portfolio. So who is eligible for federal financial aid? So for all federal direct Stafford loans, which is the official name for federal loans made to undergraduate students, there is no credit check or cosigner. Eligibility does not depend on a borrower's credit score, their credit history, their employment, their income, or anything like that. So all borrowers who meet the eligibility requirements for federal financial aid get the exact same rate and the exact same terms. So as Reed, I won't bore you again, Reed detailed nicely in his presentation on Pell, the eligibility requirements for federal student aid. So just to go again quickly through that, to be eligible for a federal student loan, a student must be enrolled at least half-time in an eligible post-secondary degree or certificate program, meet certain citizenship requirements, have a high school diploma or equivalent. For male students, they have to be registered with the Selective Service. Again, a student must certify that they are not in default on a federal student loan and does not owe money on a federal student grant, and also must sign and certify that they will only use federal student aid for educational purposes. And finally, a student must maintain satisfactory academic progress. Next slide, please. So to receive federal student aid, and a federal student loan specifically, a student must file the free application for federal student aid, commonly known as the FAFSA. Some students are then selected for FAFSA verification, which is an audit-like process, which students must complete. Those who are selected for it must complete it before they are able to receive federal aid, including grants and loans. The FAFSA opens the door to all financial aid, including loans from the federal government, state governments, and most colleges and universities. And for many colleges and universities, the FAFSA is the only form students need to file, but some colleges do require a supplemental form called the CSS profile in addition to the FAFSA. The FAFSA is used to apply for financial aid for more than 6,000 colleges and universities, and about 200 mostly private schools use the CSS profile. Next slide, please. So once a student has completed the FAFSA, they receive what's called a student aid report, which includes their expected family contribution. This is the amount the federal government determines a family can afford to pay out of pocket for college. This is determined using a complicated formula that I will not bore you with today. So when a student receives an acceptance letter from an institution, they also receive alongside the acceptance letter a communication about their financial aid offer, often referred to, we think somewhat misleadingly, as a financial aid award letter. This letter details both the free money, so grants and scholarships that a student may be eligible for, as well as the federal direct loans a student can borrow. So a student is not required to accept the full loan amount they're offered and is actually allowed to turn down a loan or request a lower loan amount than they are originally offered. Next slide, please. So if a student accepts any federal loans included in that financial aid offer communication, they must sign a master promissory note and complete loan entrance counseling. This is an online counseling module. Funds from the loan are then sent directly from the federal government, again from the U.S. Department of Education, directly to the college. The college financial aid office then applies the loan funds to tuition and fees, plus room and board if the student is living in college housing. And then any remaining credit balance is normally refunded to the student. And each year a student is enrolled, their school will determine the amount the student can borrow, as well as the loan types for which they qualify. Next slide, please. So now that I've gone through the process of a student applying for aid and receiving the loan, I'm going to actually talk through kind of some of the characteristics of the loans themselves. So there are several types of federal direct Stafford loans, and just to remember, this is the loan available to students only, not parents. We'll get to parents a little bit later. So the two types of loans available to students are subsidized and unsubsidized. Next slide, please. So direct subsidized loans are made to eligible undergrad students who demonstrate financial need. To get a subsidized loan, you must demonstrate some sort of financial need. Again, this is determined by a formula similar to the Pell Grant allocation that I will not get into during this webinar. So as you may have guessed from their name, for a subsidized loan, the federal government pays the interest on the loan during certain periods, including while the student is in school, when they're in grace period, or if they are pausing payments through deferment, which Colleen will talk about later on in the repayment piece. So the other type of federal student loan is the direct unsubsidized loan, which are made to eligible undergraduate and graduate and professional students. Eligibility for unsubsidized loans is not based on any financial need, and unlike subsidized loans, interest on unsubsidized loans begins accruing as soon as the loan is dispersed, including while students are enrolled in school. Next slide, please. So there are also limits to how much money a student can borrow from the federal government. There are both annual limits, which is the max a student can borrow for a single academic year, as well as aggregate limits, which are the max a student can borrow total across their entire academic career. These loan limits vary by where a student is in their academic career, as you can see in the slide, and whether they are a dependent student or an independent student. There's also a slight wrinkle in that students whose parents are unable to obtain the federal parent loan, again, we'll get to that a little bit later, are allowed to borrow the same amount as an independent student, even if they are a dependent student. As I said, we'll talk a little bit more about parent loans later. So just to run really quickly through this chart, dependent students who are first-year undergraduates can borrow up to $5,500, second-year dependent undergrads up to $6,500, dependent students in their third year or beyond can borrow up to $7,500. And again, this is just for dependent students who are undergraduates. For independent students, those first-year undergrads can borrow up to $9,500, second-year undergrads can borrow up to $10,500, and independent students in their third year or beyond can borrow up to $12,500 annually. And just a note, all graduate and professional students are considered independent students, and so they can borrow up to $20,500 annually. And grad students, again, are eligible only for those unsubsidized loans in which the federal government does not pay the interest, and interest accrues as soon as the loan is dispersed. So borrowing is more expensive for graduate and professional students than it is for undergrads. Next slide, please. So just to again briefly go over the aggregate loan limits, in total over their entire academic career, a dependent student can borrow up to $31,000 in federal student loans, of which no more than $23,000 can be in those subsidized loans. Independent students are able to borrow up to $57,500, and same as dependent students, no more than $23,000 of that can be in subsidized loans. For grad and professional students, the aggregate lifetime loan limit is $138,500, and that total number does include any federal loans the student took out as an undergrad. You'll see two handy charts from Federal Student Aid again, do a nice job of laying out both the annual and the aggregate loan limits. Next slide, please. So the final piece of the loan puzzle, of course, is the interest rate. Congress actually sets the interest rates for federal student loans yearly based on the 10-year Treasury note. So for all federal education loans, the rates, again, are set by Congress and are fixed for the life of the loan. So the current interest rates for federal student loans dispersed from October 1st, 2019 through September 30th, 2020 are on both the subsidized and unsubsidized loan for undergraduates. So any loan going to an undergraduate student, the interest rate is fixed at 4.53% with an origination fee of 1.059%. And then for graduate and professional students, again, they are only eligible for that unsubsidized loan, as not the subsidized loan. So that unsubsidized loan for grad and professional students carries an interest rate of 6.08% with the same 1.059% origination fee. So as I said earlier, it is more expensive for graduate and professional students to borrow federal student loans. Next slide, please. So as I promised, I'm going to quickly go over the Direct Plus loan, which is can be made to either parents of a student or a graduate and professional student. Just a quick note on the graduate side, Graduate Plus loans are typically made to grad students who need additional funds after they've exhausted those unsubsidized direct Stafford loans. So just a little bit of background on the Parent Plus loan. It is, again, a federal direct loan. The lender is the U.S. Department of Education. This is made available to the parents of dependent undergraduate students. These loans are typically used by a parent if the student has unmet need, they have a gap in funding, after they exhaust all of their federal student loans. Eligibility, similar to the federal student loan, does not depend on financial need. And as again with the federal student loan, everybody in the Parent Plus loan program gets the exact same fixed interest rate and loan terms. However, a Parent Plus borrower cannot have an adverse credit history. So there is a little bit of a wrinkle there, but there are no additional income checks or cosigners required on top of that one check as to whether or not they have an adverse credit history. And the current Plus loan rate for both parents and graduate students is 7.08% with a 4.236% origination fee. So as I said, again, these loans are typically used to fill the gap if a student has exhausted their lower cost student loans and still needs to cover cost of attendance. Their parent is able to take out that loan, again, at a much higher rate. And just a final note, not in the slides, but just something I wanted to flag for everyone on this webinar. As I said, some students and families will have a gap in coverage of what they need to pay for school and what they're able to get through their federal student loans. So sometimes a student or family borrows a private loan to cover this cost gap. So while private student loans, or rather private education loans, they're typically actually taken out by a cosigner because the student typically doesn't have the credit history or credit profile to get these loans taken out. While these loans account for less than 8% of total outstanding student loan debt, there are still a number of families who do take out private loans. They can come from a variety of sources, including banks, credit unions, and state agencies. And just one other brief note, specific to California, nearly 1 million community college students cannot get a federal loan, even if they need one, because their school does not participate in the federal loan program. And Laura, our associate California program director, actually is going to discuss that piece a little bit more during our Q&A, but I just thought that was an important note to add on to the end here. With that, I will turn it over to Colleen to talk about loan repayment.
Thanks, Michelle. So my name is Colleen Campbell. I'm the Director of Post-Secondary Education at the Center for American Progress. We are a nonprofit, nonpartisan, progressive think tank in Washington, D.C. We focus on a variety of different policy issues, though my team only focuses on post-secondary education. And our work is largely around affordability and quality assurance in higher education, with a specific focus in those policies on promoting equity. Next slide. So Michelle kind of went through what the current what the current loan scheme looks like, though I do want to just make you aware of a couple of other types of federal loans that you might hear about, if you're talking with borrowers, particularly if they're borrowers who had first enrolled in college prior to 2010. So today we're talking about direct loans, and that's mostly what my presentation is going to encompass. Direct loans right now account for about $1.2 trillion in outstanding debt, and there's almost 35 million borrowers in the system. Those loans are repaid through what are called servicers. They are 9 different contractors that the federal government uses to manage repayment. So they have websites that the borrowers visit to manage their accounts. They collect payments. They offer counseling over the phone and online through chat tools, and they process forms for borrowers. There are 2 other types of loans, though. There are federal family educational loans, or FFEL loans. This program existed prior to 2010, and that means that the portfolio right now is relatively small and it is shrinking by the day. These were loans that were federal in nature, so they had certain terms that banks basically had to comply with. And so students went to those banks to get those loans. The federal government paid subsidies to those banks. to manage federal loans for borrowers, but if the borrower defaulted, the federal government bought those loans back. And then there are Perkins loans. That is a program that no longer is making new loans, but there are a lot of those loans kind of outstanding. These are loans for students with financial need, and they were kind of distributed and serviced by institutions. So you might hear a student having a Perkins loan that is kind of separate from the federal loan system now. Next. It begins when the student is in school, in fact. So no payments are due when a student is in school. If a borrower has unsubsidized loans, though, there is interest accruing that also applies to both parent and Graduate Plus loans. And when the borrower leaves school, that's either dropping out below half-time or graduating, they enter a grace period. That grace period is 6 months. No payments are due during that time, but a servicer will be in contact with the borrower to let them know, what website they should go to repay their loans. They should alert them as to when their first due date is and the amount that's due in their first payment. While the borrower is in repayment, their payments are due monthly. The servicer will be managing all the outreach to the borrower. They likely won't be hearing from the Department of Education. And if the borrower has payments that are unmanageable during that period of time, they can either choose to change their repayment plan, and I'll go into much more detail as to what those repayment plans are, or they can choose to pause their payments through either a deferment or a forbearance. Moving into those white kind of boxes, this is what happens when a borrower fails to make payments. So the borrower goes into delinquency after they've missed 1 month of payments. When they have missed 90 days of payments, so three payments, 3 months, their delinquency is reported to their credit bureau. That can have long-term repercussions because it can last on a credit report for up to 7 years, even after the borrower resolves the delinquency. So that 90-day mark is really one that we want to help borrowers avoid. Borrowers can go delinquent up to 270 days, and that's technically when a default happens. When a borrower defaults on their loan, there are major repercussions for them, both in terms of their credit and their finances. So with their credit, the default can remain on their credit report for up to 7 years. That can prevent them from renting a home, getting another loan, or access to other credit products. In some cases, it can also prevent them from getting a job. Certain states, not California, thankfully, but some other states do prevent those who are in default on a federal education loan from getting a license. And so that can have obvious repercussions on those who are in default. And truly, it leads to unavoidable collections. And so because an education loan is unlike other types of loans where there is collateral, you can have your car repossessed, you can't really have your education repossessed. So what happens in these cases is the government either initiates administrative wage garnishment, which is basically suing your employer for a portion of your wages. This also applies to folks who are receiving Social Security income, or they can engage in what's called treasury offset, and that essentially means withholding an individual's tax refund in order to repay their federal student loan. Part of the problem with this is that it also takes funds from individuals who are low income and are filing taxes for their earned income tax credit. So it's very difficult to avoid collections on federal student loans, and it has long-term negative repercussions. So it's definitely an outcome that we want to avoid. Can we go to the next slide? There are several repayment plans available. In this situation, I'm mostly talking about direct loans, though most of these repayment plans are available to FFEL borrowers as well. The kind of automatic plan that everyone is put into is a standard plan. It is a 10-year fixed payment plan, and the minimum payment is $50 per month. There's also a graduated plan that also has a 10-year term, and payments on that plan start out low and then increase every 2 years. There's also extended versions of the standard and graduated plans available. So those are available for individuals whose loan balances total over $30,000, and those folks are able to pay over an extended period of time, so more than 10 years. There's multiple income-driven repayment plans. These are plans that base monthly payments on a borrower's income. I'll go into a little bit more detail on those plans in the coming slides. And there is also, just for your awareness, an alternative plan. The payments for that plan are negotiated, and it's only available to borrowers for 1 year, but it is something to kind of be aware of, though it is very rarely used. Next slide. So the 4 income-driven repayment plans, which is IDR, the umbrella term for the alphabet soup that we're about to get into, is income contingent repayment, income-based repayment, pay as you earn, which is also called new IDR, depending on when you borrowed, and revised pay as you earn. Next slide. Now, the amount that borrowers pay depends on the income-driven repayment plan that they select. So it's based on adjusted gross income, family size, and tax filing status in most situations. Essentially, the borrower under most of these plans pays either 10% of their discretionary income. That's under pay and repay. Those tend to be the most common plans that folks use because of that lower payment amount, the 10% of discretionary, rather than 15 or 20% of discretionary. And those plans also offer, I guess I should say all of these plans offer forgiveness after a certain period of time. So a borrower that's looking to participate in something like the Public Service Loan Forgiveness Program, or to receive eventual loan forgiveness after 20 or 25 years of repayment, has to use one of these repayment plans at some point in time, because these are the ones that extend your repayment and show that you have some financial need, as opposed to plans like the graduated one or the extended plan, which are solely predicated on the amount that the borrower borrowed. What's also important to note in these plans is that if you enter them and exit them, you essentially end up capitalizing your interest. So under all of these plans, you can make a payment that is as low as $0. So if you're making a $0 payment, you still are having interest accrue on your loan. So what ends up happening is that interest accrues on the loan, and you're responsible for paying that interest off eventually, unless you hit that forgiveness threshold. But what happens during that period of time, if you allow your income-driven repayment plan to lapse, is that interest can get added back onto the principal amount of the loan, and thus that would end up making the loan more expensive to repay in the long run, right? So you have a higher balance, interest begins to accrue on that higher balance, and thus you end up paying more over the life of the loan. So it is important to note for borrowers, they have to complete an application to get into one of these plans, and they have to recertify their income every single year that they're in it, or else they will face kind of increased fees and an increased balance on their loan if they're not paying down their balance. So an income-driven repayment plan can be a really good way for borrowers to reduce their monthly payments, though it will likely extend both their repayment term and make their balance higher in the long run. Can we go to the next slide? One other wrinkle to consider in the income-driven repayment plans is not just, how much you will owe of your discretionary income, which is, 10, 15, 20% of that number, but it also takes into account interest subsidy benefits. Now, you can see that this is extremely complicated, so I won't get into it too in depth, but I think it's important for everyone to understand that in the time that a borrower is in repayment, depending on the IDR plan that they choose, they will have some of their interest subsidized if they're not making kind of that monthly payment that is going to pay down their actual loan balance. So let's imagine that someone is paying a $0 payment and their loan is what's called negatively amortizing. So, interest is accruing faster than the borrower is paying it off. In some of the plans that exist, so IDR pay and repay for subsidized loans, 100% of that negative amortization is going to be subsidized. So that is going to reduce the cost of the loan long term. But that's not the case for unsubsidized loans in Repay and for all loans in ICR. So I think that it's just important to consider that it's not just the kind of percent of income that's paid, but also these interest subsidy benefits. And so when you're counseling a student or a borrower to use income-driven repayment, that you should use an online calculator like the Office of Federal Student Aid's repayment estimator to really get a sense of what that borrower is going to owe in the long term, because these interest subsidy benefits actually can have a pretty substantial impact on the total amount paid. Next slide. And so I just wanted to walk through a quick example of what IDR payments might look like for someone. So this uses average debt of a student who graduates from a public four-year college. That's about $27,000 at about a 4% interest rate. And that's making an adjusted gross income of $35,000 and is single with no dependents. Next slide. So this is typed into the Federal Student Aid repayment estimator, what the repayment term would look like for that student. So they borrowed less than $30,000, so they're not eligible for an extended repayment term. So we see for standard and graduated plans, they're paying over 120 months, which is about 10 years. And they are making payments that are for the standard plan fixed at $272 a month for that entire 10-year term, or that start at $150 and go up to $455 over that 10-year term for the graduated plan. Then we kind of go into all of these income-driven repayment options, and you can see that the amount, the monthly payment amount is similar for some of them, but the starting payment is what's similar and the longer term payment is more expensive. So in the case of Repay and Pay, we have a monthly payment amount that's about $136. And for revised Pay as you earn, that can go up to $338 a month. Whereas under Pay as you earn, that amount is more capped to the standard monthly payment amount. And then finally, going all the way down to income contingent repayment, I just want to kind of draw your attention to that plan because it starts at $182 a month and goes to $216 a month. So the swing is much less, but the borrower will be in repayment for the longest period of time, 181 months. And so that's something to consider, that ICR will almost always offer a borrower a more consistent monthly payment amount, but it will likely have them in repayment for the longest period of time based on the way that that plan is structured. So this is, I think, just to say that there are many plans available to borrowers, and whenever you're either, you are looking at repaying your loans or you're counseling a student as to their options, it's always important to weigh the amount that's going to be paid per month with the amount that will be paid in the long run and the amount of time that will be spent in repayment, because you can have someone, that expects to be paying their loan for 10 years when really they're going to be paying for 15, 20, 25. So that's just something that I wanted to draw your attention to. If you just Google FSA repayment estimator, you'll find this tool pop right up. And the nice thing about it is that borrowers can log in with their credentials that they use to complete the FAFSA and actually find their specific loan amounts so that they don't have to kind of guess as to how much they owe the federal government. Next slide. And I had mentioned some of this before, but I think it's important to reiterate that borrowers have to complete an application and provide income documentation every single year that they're enrolled in an income-driven repayment plan. They can either get this information from their servicer or they can fill it out on studentloans.gov. The payments that the borrower makes may be less than interest that's accruing on the loan, which can kind of increase the cost of the loan in the long run. Any outstanding interest is going to be added to the principal balance of the loan when the borrower leaves the plan, and forgiveness in all of these plans is available after 20 or 25 years of payments, depending on kind of how you borrowed, whether it's for graduate or undergraduate education. And of course, there is forgiveness available after 10 years for borrowers who are using public service loan forgiveness, which is for those working full-time in public service fields. And next slide. I just want to also quickly mention that there are postponement options for payments. If a borrower is, kind of experiencing longer term issues in repaying their loans, an income-driven repayment plan is really the best way to help them kind of navigate their repayment system. But if it's only going to be a short-term period of time, so, if someone has lost their job, but they kind of have another one lined up almost immediately, and they're just going to need a couple of months to wait on making payments, they can take either a deferment or a forbearance. Deferments are preferable, and they're available for a wide variety of situations. So if a student re-enrolls in school more than half time, if they're serving in the military or in the Peace Corps, like I said, if they lost their job or experiencing other economic hardship, they can apply for a deferment, be approved, and use it for a brief period of time. The positive thing about a deferment is that no interest accrues on subsidized loans. So unsubsidized debt will accrue interest whether the student is in a deferment or a forbearance. With subsidized loans, though, deferments are preferable because interest isn't accruing. There are also forbearances, and there are two types, mandatory and administrative. Sometimes a borrower's servicer will put them into a forbearance if they're doing something like processing paperwork and they don't want the borrower to go delinquent during that period of time. The servicer will just put a forbearance on the borrower's account. But the borrower can also request a forbearance from their servicer. Documentation typically isn't required for a forbearance, but interest does accrue on all debt. And so that's something that's really important to consider, that, using a postponement option, while it will allow someone to not make payments for a period of time, that they are going to increase the cost of the debt. And whatever interest does accrue during a period of deferment or forbearance, it's going to be added onto the principal balance of a loan. And so therefore, when it's added onto the principal, that means that the loan balance grows, and therefore the loan is accruing more interest in the long run. So I think that that's just important to keep in mind. Next slide. And finally, I mentioned some of the problems with default that happens after 270 days of non-payment. Wage garnishment and tax return offsets are a big problem. There are ways to get out of default. There are basically three of them. The first is to rehabilitate the loan. So that means that the borrower makes 9 on-time monthly payments that are negotiated with their debt collector. Those payments can be as low as $5 a month, but keeping in mind that that $5 a month, once the loan goes back into regular servicing, can't be maintained. And so I think that it's important to note that, a rehab is going to take about 9 months, but it is going to be the most favorable option for a borrower. That essentially means that the borrower is going to have the default removed from their credit record. The loan is going to go back into regular servicing, and they're going to pay the least in collections fees. So rehab is a good option, though it does take the better part of a year to get out of default. There's also consolidation. This allows a borrower to essentially make a new loan out of their defaulted loans. And when they make that new loan, they agree to pay under an income-driven repayment plan, and that should, one, reduce their monthly payments once they get back into regular servicing, and can be done immediately. The bad thing right now, though, about consolidating out of default is that it leaves the record of default on their credit report, and so will continue to kind of have negative repercussions on the borrower's credit for a pretty substantial period of time. And then finally, borrowers can pay off their loan while they're in default. This is actually, though, the worst way to get out of default. Even though you're settling up with the federal government, paying off a loan in default means that you'll pay the most in collections fees, and it also means that the default will not be removed in any way from the credit record, and there's no way to fix that. And so if a borrower has a low amount in default and they're saying, well, it just makes the most sense for me to pay off the loan, advise them to not do that. It's actually best for them to go through the rehabilitation process and then to pay off their loan once they exit rehab. And that's because it will have, just paying off will have leave the negative repercussions on their credit report for a long time. And then finally, just something to note, there isn't any statute of limitations on debt collection, so borrowers will remain in collections until that debt is paid off. So, defaulting on federal student loans is extremely punitive, and it's very hard to avoid the collections consequences of it, and it will follow you for a very long time. So, defaulting, especially with the income-driven repayment plans that exist, really shouldn't ever be considered an option for borrowers. They should always, take a path toward repaying their debt because the federal government is going to get their money one way or another. Next slide. That's it for me. Thank you.
Well, thank you, Colleen and Michelle and Reed, so much for this wealth of information. It's been incredibly helpful for me, and I've been in this field for a long time. I know that we're already past the 1 o'clock hour, so thinking maybe we can just take a couple questions if folks are able to hang on. If not, of course, we understand, and feel free to email us your questions and we can loop back with you. One question I got for Michelle, what is the process to restore the purchasing power of the Pell Grant? Who are the elected leaders at the forefront of this effort, and how can we get involved?
Sure, thank you. This is a really great, important question. So I think Reed kind of spoke a little bit to this, but I'll just add a little more color. So as I'm sure everyone can imagine, there's a wealth of research showing that to fully close disparities in college opportunity, we need to make these really significant large investments in the Pell Grant. So currently, Pell covers less than 1/3 of the cost of attendance at a four-year public school. At its peak, it covered 3/4. So what we would like to see is Congress to commit in statute to at least put the Pell Grant on a path to covering roughly half of the four-year public college cost of attendance. So again, we'd like to see Congress kind of intentionally commit, even if they can't do it right now, based on political realities and budget realities, at least intentionally say in bill language that they would like to see Pell put on a path to doubling the current maximum Pell Grant, and again, eventually covering at least, at minimum, half of that four-year public college cost of attendance. In addition, as Reed also mentioned, it's really important to restore the grant's automatic annual inflation adjustment. This will ensure predictable increases to maintain the grant's value and reduce future erosion of the purchasing power. So just another flag, the House Democrats' Higher Education Act bill, which again is being marked up publicly tomorrow. You can watch a live stream. It does include some really important new investments in the Pell Grant, but I would actually encourage everyone on this webinar to kind of speak out and contact your representatives and encourage them to make even more significant additional investments in Pell. Again, with that specific intent to say, we need to at least put Pell on a path to getting back to covering much more of the cost of attendance at a four-year public school, and would like to see you kind of make those investments a priority. Okay.
Thank you so much, Michelle. That's super, super helpful. I just wanted to open it up to see if anyone else has any questions, if they want to type it into the Q&A feature. And while you're doing that, I'm happy to speak to the issue of federal student loan access in California that Michelle had mentioned earlier. For quite a while, close to 24 California community colleges did not offer federal student loans. It's actually up to the college to offer them. The two main reasons had to do with, number one, legitimate concerns around cohort default rates, and also the administrative burden. But there have been a lot of protections put in place. For example, there is something, this is a bit wonky, so please feel free to follow up with me offline if you'd like to learn more about it, called the Participation Rate Index. The upshot of it is that really no community college should lose access to Pell Grant from a too high cohort default rate. So that was a fear that some schools had, but really is not really a concern. And also the Community College Chancellor's Office has a great cohort default prevention program that they run, where you can reach out to them and get training and best practices for running a healthy student loan program. The final thing I'll add on that is that you may have heard of AB 19 funding that came into effect about a year ago, and with in order for community colleges to get that funding, they have to offer federal student loans. I believe that there are still a handful of community colleges that still choose not to offer federal loans and are foregoing that funding, but many of the 22 colleges that hadn't been offering it are now offering it and are back in the program. So with that, I'm looking and I'm not seeing any other questions coming in. I'll turn it back over to Angelique to close it out, but please feel free to reach out to us individually if you have any other questions.
Thanks, Laura. That concludes today's discussion on federal grants, loans, and repayment options. Thank you again for our viewers who joined, and to Reed, Michelle, Colleen, and Laura for providing such an informative discussion. If you have further questions, as Laura said, please feel free to reach out to any of the panelists. Their contact information is up. And also wanted to give a friendly reminder that this webinar and a brief feedback form will be circulated. So if you could please just take 3 minutes to answer 3 short questions, we would greatly appreciate it. Also, it would be a great way for us to improve your next webinar experience. We hope to see you at our all again for a discussion on institutional aid slated for November 18th.